India's bond and currency markets are being swept by some unprecedented volatility. First, the latest news, April inflation is at a 6-year low of 3.16, and post the announcement, most economists have brought down their forecasts for full-year FY26 CPI to below the RBI estimate of 4%. Now, when did we last have a time when full-year inflation averaged below 4%? So, how low may India's rates and yields go? There is even more volatility in currencies. Since February, the rupee has touched an all-time low of 87.95 per dollar and a high of 83.75. I mean, that's a 4 rupee difference or a 6% difference between high and low, all in a matter of 3 months. So, where are bond yields and the rupee headed? I'm joined by two experts, Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities PD. Gentlemen, thank you very much indeed for your time. Neeraj, with your permission, first let us settle this inflation number that has come in. What's your sense now? The full-year inflation likely to be 3.8 or 3.5, according to economists. Should we expect the end repo rate to be even below 5.5?
So yes, our expectation is that the full year inflation is going to be lower than 4%, which is Reserve Bank's target. And that does give RBI the space to do some more rate cuts. At this point in time, I am expecting one rate cut in June and one rate cut in August, and we'll take it from there. I think it's a bit too premature to talk about a full 100 basis point rate cut, as some have been talking about. But 50 seems to be something which is kind of given in some senses, given the inflation outcome. And the markets are also pricing in about 50 to 75 basis points in the next 2 months' time.
Exactly, yeah. If not 175, Abhishek, where do you stand on that? The CPI number actually has come below our poll. It may be different for you, but our poll for the last 4 months, the actual number is a good 5 to 10 basis points below the street expectation. So should we expect a lower than expected CPI, maybe 3.5 for the full year, and therefore repo rate?
Well, Latha, the CPI data was even more benign once you additionally consider there was no big base effect this time. Also, there were some one-off factors imparting upward pressure on this print, including higher gold prices, which are up 6%, more than 6% month on month. LPG prices were also higher. So if these were not headwinds, headline inflation would have been even lower. Given view this year, range will be above normal for second consecutive year, benign global commodity prices, and view of more or less sideways or softer growth compared to last year, RBI should have a lot more conviction heading into the June meeting that inflation will be below 4%. We think inflation could average around 3.5%, but we're less sure RBI will be aggressive in revising down their inflation forecast to that level. We do expect two rate cuts from here. If you're looking at the inflation trajectory, you would believe there could be scope for more, but if downside risks to growth are judged to be moderate, we would expect RBI to be reasonably conservative in setting the floor for the policy rates in this cycle. And 5.5% is a reasonably benign repo rate, and effective rate could be even lower, between 5.25, 5.5. Even right now, the weighted average call rates are below repo rate at around 5.85%. And the overall rate, the weighted average overnight rate, once you additionally consider the collateralized market borrowing and lending rates, is around 5.8%. So already quite close to 5.75. This trend may sustain given surplus liquidity, but we don't expect more than 2 rate cuts with some stealth easing right now.
Okay. So very quickly, what's your end-year view of the 10-year yield, Abhishek?
Well, Latha, so bonds tend to rally most in the run-up and in the early stages of rate cut cycle. This time the move has been turbocharged by RBI injecting significant liquidity also in this period. We are still in the middle stages, and maybe there is some more downside from here. But we would expect 10-year yields to bottom somewhere around between 6.10, 6.20 levels, and maybe go higher once market comes to expect that rates have now bottomed and the next move is towards a higher policy rate. So end of the year could be higher than this range that I'm talking about.
Oh, okay. Neeraj, just that one number, and then I get to rupee. 6.26 now on the new 10-year. How low does it go this year?
I think hard to see it going below 6% for now because we have another 50 basis points of rate cuts to come. There is still no visibility of any possible rate hikes down the line, maybe 12, 24 months down the line. So I think market will kind of settle down somewhere close to 6%, give or take 10 basis points on both sides.
That also is unprecedented, right? Only during COVID, perhaps we had a couple of months, but otherwise, even 6% is kind of unprecedented in India for several decades. But Neeraj, now the more important question of the rupee. I've never been so confused. Is the direction of the rupee towards 87 or is the direction of the rupee towards 84? We don't know. Every day is a new day. What's your sense? Do you think the dollar is in for more sustained weakness and we are likely to see the rupee actually strengthen, go towards 84?
Yeah, so I think we have two opposing forces at this point in time from a global currency market perspective. Firstly, the dollar. We've seen some strength in dollar ever since the announcement of some kind of truce between China and US on trade talks. We'll see how that plays out, but I think there is, from here onwards, there is potential for some more positive news for the market as some of these trade deals get, announced with large countries, including possibly India. And there is more progress on China and US trade talks. So I think that on the balance will be positive for US market from a growth perspective, as well as from an inflation perspective. And that could actually bring some life back into long dollar trade. Although from a structural standpoint, I think the market is still quite bearish on dollar and feels that the dollar needs to, depreciate over a longer period of time. But you could have some, intermediate sort of rally in US dollar index. The other factor for us is China. And given what has happened has actually far bigger bearing on China than probably on US. And the fact that over the next 90 days, since the start of this kind of pause, we will see a expedited sort of amount of exports taking from China to US, which is going to be positive for Chinese economy and Chinese balance of payments. So I do feel that we will also probably simultaneously see some kind of yuan strength, which we're already starting to see in the market. And from rupee perspective, yes, strong dollar means weaker rupee, but stronger yuan means lesser sort of pressure for the rupee to weaken. So my view is that on balance, given these two opposing forces, we could potentially see some volatility around the current level, but not very large moves for some time, maybe for the next 2 to 3 months.
Okay. No, I'm worried. Even as you were talking, we were showing the year-to-date rally of Asian currencies. And currencies like Taiwan, for instance, have risen by 8.5%. And there are quite a few currencies which have risen about 3 to 4%. India included has risen against the dollar. So my point is this big worry in the market that it won't be just tariffs that will be negotiated, but countries like India would be pressured. There are people who even say China that was one of the unspoken pressures in the Switzerland meet, that, you have to appreciate your currency or let your currency appreciate. And true enough, the Chinese yuan appreciated by 4% after the Switzerland talks. So will there be a arm twisting to allow the currency to appreciate, or even something very overt like buy 100-year US treasuries?
I'm hard to see how you can actually bake in a currency weakness in the hard trade negotiations. Ultimately, if the objective of these trade negotiations is to balance US balance of payments more, maybe reduce the current account deficit, that itself should be some kind of a respite for US. So I'm not sure whether they can have a very formal agreement between the currencies to say, okay, weaken your currency versus US dollar, and that's something that kind of gets priced baked in. My sense is that any positive, trade agreement between US and India will be eventually positive for rupee. So I think there will be a pressure on rupee to, in some senses, appreciate against US dollar, provided we see a good outcome on the trade front. Otherwise, I think it's going to be pretty narrow range. Also, bear in mind that too much of appreciation can also not be talked about, because Reserve Bank has spent quite a fair amount of reserves in terms of defending the currency in the down move, and any significantly disproportionate appreciation will be used to kind of build back the reserves and sort of balance the forward position that Reserve Bank has. So I think, again, I don't expect more than 2 to 3% move on either side.
Okay, on either side, but more likely we will end the year towards 87?
I'm not so sure, Latha. I don't think it's a clear-cut case for depreciation from here onwards.
Abhishek, what is your best guess? Are we likely to see further appreciation of the currency from here on, considering that, your deficit with the US is going to fall?
What is peculiar about this move in Rupee, Latha, is that on a real effective exchange rate basis, Rupee has still weakened significantly. So on a real basis, we will now be closer to 100 levels, which will be lowest in about 2 years. That, from a trade perspective, allows RBI to still absorb more appreciation, perhaps. But I broadly am sympathetic to the view that given dollar weakened when US imposed very high tariffs, and some of those proposals are now being reversed, it is possible dollar can bounce back a little bit. In this period, RBI can allow Rupee to depreciate, and particularly now that the offshore short dollar book that RBI had has also now virtually been extinguished in this period of Rupee appreciation. Medium term, I also agree that dollar is very rich. In fact, if you look at the USD on a real effective exchange rate basis, it is the most expensive since the dot-com bubble period. There is case for dollar to weaken, therefore, from a slightly longer perspective. In that period, Rupee should be well behaved. Typically, Rupee doesn't appreciate much in periods of dollar weakness, given our positive inflation differentials with the rest of the world, which anyways dictates some weakness every year. So typically, Rupee tends to flatline in such a backdrop. Okay. That is what I would expect also, unless dollar weakness is very pronounced, basically looking beyond next few months. So broadly, I think Rupee goes up a little, Rupee depreciates a little bit near term against the dollar, but then stabilizes around these 85, 86 kind of levels further ahead.
Okay, interesting times we live in. It's quite possible that some geopolitical announcement comes tomorrow and all of us have to change our views, actually. Thank you very much, Neeraj Gambhir and Abhishek Upadhyay, for joining me. We must expect Indian yields to fall. You will see the 10-year yield go perhaps all the way to 6%, and the Reserve Bank cuts could be 2 or maybe even 3 cuts this year. Rupee likely to be flat to slightly declining, but it's anybody's guess. Wrap up on Bazaar on that note. Chartbusters coming up.